Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Hi, I'm your host, Erin Allen with BMO ETFs. Welcome to today's episode. Today's session is focused on understanding technical analysis. So we're going to do an intro into what is technical analysis, what are some of the popular approaches out there, and then how it can be applied within portfolio construction. Now, just as a reminder, today we are not providing you any advice or investment recommendations. Today's show, as with all of our shows, is about providing you education around investing and around ETFs for investors who are really looking to take charge of their own portfolios. With me today, I have my colleague Alfred Lee, Portfolio Manager with BMO ETFs. And just a note on Alfred, he has earned his Chartered Market Technician designation, CMT, which is going to come in handy in today's discussion. I'm also joined by Colin Cieszynski from SIA Wealth Management. You might recognize Colin. He's a frequent guest on BNN. He's also a Chartered Market Technician as well. And just a bit of background on SIA. SIA is an investment management firm that's based out of Calgary, and they use technical analysis for effective risk management within their tactical portfolios. So we're really happy to have them here today. BMO ETFs has partnered with SIA on 2 ETFs, which we're going to get into. We launched them about 4 years ago, ZFC and ZFN, but more to come on that later. Thanks, Colin and Alfred, for joining me today. Before we get started, just a quick reminder to check out our YouTube channel to watch any episodes that you may have missed in the past. Remember to subscribe and ring that bell so that you are notified of any episodes as they go live. Now, for today's 1-minute update, I wanted to highlight weekly flows. This is from last week, and specifically what we're highlighting here are the top 5 ETF subscriptions and the top 5 ETF redemptions. You can see all BMO ETFs across the top 5, which is nice to see. We can see that mid-US investment grade bonds, a couple large tickets there, ultra short-term bonds, which we've talked about a lot as a sort of a cash alternative product. And last but not least, the reason why I chose this chart, we have 2 SIA focused products that we have, ZFC and ZFN highlighted here, 2 large tickets last week. Again, we're going to touch on these products more in detail as the session goes on. And then on the redemption side, I'll just speak generally. You can see that most is coming out of those broad market equities as investors continue to feel that heat from the markets. Now, let's get into it. Enough from me. Hi, Alfred. I'm hoping you can kick things off and provide us with an overview of technical analysis and how it compares to fundamental analysis, which I think most of us are a bit more familiar with.
For sure, and good to be back. Always great to be back on the Market Insights webinar. But to point out, I think there's 2 distinct approaches to investment analysis. Fundamental analysis is obviously what we learn in business school, looking at the financial statements of a company and then digging it apart, comparing it to the peer group and the industry, and then looking at macroeconomic analysis, maybe some political analysis, and estimating potential future profits for the company as well. So it's as I mentioned, I think it's what we learned in traditional investment analysis, things like in business school and a lot of investment courses. Technical analysis covers what I would say is not what's covered by fundamental analysis. A lot of people think it's mutually exclusive, but I think they're very complementary actually. So technical analysis, I think when people think about it, think about technicians just simply drawing lines on chart. It's more than that. In fact, I would say it's a study of supply and demand. I think there's a lot of other studies than just looking at lines and charts. For example, there's a lot of quantitative measures that look at momentum like RSI and MACD. There's a lot of other measures such as relative strength, so comparing one asset to another or one stock to another, which I think is very useful. And I think another topic that Colin's going to cover in his segment is essentially inter-market analysis. And I think inter-market analysis is one of the most useful tools when it comes to putting together portfolios. It essentially compares, what's happening in one asset class and the impact on another. And I think when you're looking at a well-balanced portfolio and a holistic portfolio, inter-market analysis is very useful. So overall, I think fundamental analysis and technical analysis are different approaches, but they're very complementary. I think, in the last 10 years, I think there's a lot of, we used to think that markets were always rational, but I think in the last 10 years, we've come to realize that that's far from the truth. They're actually highly irrational at times, and technical analysis captures a lot of that behavioral analysis that fundamental analysis does not cover.
Perfect. Thank you for that. Now, the history of technical analysis goes back quite some time, hundreds of years, and Charles Dow is sort of considered the father of modern technical analysis. Can you give us an intro into what his theory, the Dow Theory, said and how it's still relevant today?
Sure. So there, as you mentioned, Dow Theory goes back a very long time, over 100 years. Basically developed by Charles Dow, which, as you mentioned, is the godfather of technical analysis, many would say. But it does subscribe to a number of principles. So it does say that, the averages discount everything. So essentially, efficient market hypothesis. So there's two averages. There's the Dow Jones Industrial Average, which is still used to today. There's the Dow Jones Transportation Average, which is another average that is used in Dow Theory as well. The transportation average is a little bit less followed today, but a number of different other principles are followed as well. So there's three trends. There's a primary trend. So if we're in a bull market, that is the main trend. There's also a secondary trend that tends to run counter to the primary trend. So think about, if we're in a bull market and you get a short-term correction, that's essentially the secondary trend. There's a minor trend as well, which is basically the day-to-day noise that, a lot of day traders may use. And then the major trends essentially have three phases. There is a counter trend, which is, think about it, if during a market bottom, people start accumulating stock, they're basically going against a common narrative. And then basically when you see the market trending, that's when you see, the trending market. And then there's also a panic phase. So, at the top of the market, a lot of the kids would call it the FOMO effect at this point, right? The fear of missing out. That's essentially the panic phase at the market top, and at the market bottom, there's also a panic phase as well. Some other principles is that the averages must confirm each other. So if the the industrial average is going up, the transportation average must confirm it as well. Volume is often used to confirm the trend, and then the trend is assumed to be in effect until it reverses. So, as you mentioned, it is an old principle. It's over 100 years, but as mentioned, there's a lot of these principles still are very valid to today, and I think the Dow Theory could still be applied to today's market.
Perfect. Thanks, Alfred. And sticking with you, technical analysis, of course, can be applied to individual stocks. You can look at indexes with it, but you can also look at ETFs. How can ETFs be used? What's the benefit of looking at an ETF, and what are some things that investors should consider if they're using ETFs for technical analysis?
For sure. I think a lot of people think of technical analysis being applied to individual securities. Technical analysis could actually be applied to a number of different things, whether it's interest rates, bonds, commodities. A lot of people use it for indexes, which I think is a great segue for ETFs, given that a lot of ETFs track indices. So a lot of the common measures and the common tools that you find in technical analysis, things like MACD, RSI, relative strength, those could be applied to ETFs. One thing I'd be hesitant to apply to ETFs is the volume indicators. And the reason why is because when you look at individual stocks, say IBM, for example, there's a fixed float of securities, right? There's X amount of shares outstanding. So when you get a big buy order, a big sell order, that's going to give you confirmation in terms of pushing up the market or pushing down the market in terms of having a market impact. With an ETF, given that it's more like a mutual fund in terms that it's open-ended, that supply could change to offset the change in demand. So because of that, that volume indicator, I would say, is less of an indicator in terms of confirmation of a trend that we see in the market. So I'd be a little bit hesitant to use volume indicators for ETFs, but every other technical analysis tool out there could be applied to ETFs other than volume.
Perfect, thank you. Now let's get into some of the actual techniques. Moving average is probably one of the most commonly heard approaches. Can you walk us through how these work and how you can read the different moving averages?
Yeah, so I would say moving averages are the most simple of the quantitative indicators used by technicians. And essentially, there's just a moving average, as the name indicates. So the most commonly used ones are the 50-day moving average and the 200-day moving average. The good thing about these is that you could adjust it to whatever your time horizon is. So let's say, for example, if you're a shorter term trader, you could say use a 5-day moving average versus a 20-day moving average as your longer term indicator. The shorter the time horizon, the more reactive it's going to be. And the longer the time horizon, the more stable it's going to be. But the way you could use it in terms of buy and sell signals is that if the 50-day moving average moves above the 200-day moving average, it's essentially a buy signal. So that's what's called a golden cross. And then the opposite of that is when the 50-day moving average moves below the 200-day moving average, that's considered a death cross, which is a little bit of an ominous name, but it's a great tool. It's very simple, but at the same time, you could combine it with other technical tools out there, whether it's the MACD and other quantitative indicators as well. So a very simple tool, but very effective in certain markets as well.
Perfect, thanks, Alfred. Now, Colin, thanks for your patience. I want to bring you into the discussion now to give us an introduction to some of the other approaches that are used. Most of these you implement at SIA as well. So first up, let's look at point and figure charts. I don't know about everybody else here, but these are one of the more intimidating charts for me to look at. Can you walk us through, break this down for us, tell us how to read them and what they can show us?
Absolutely. Point and figure charts are a little bit different than the bar charts or candlestick charts or line charts that we're used to here in North America. The charts that usually are used are you have one mark for every single day, and it's very time dependent and shows what happens over time. With point and figure charts, however, the primary focus is on price, and charts only change when there's actually a significant price move, not necessarily when there's a change in time. So they're more focused particularly on trends, and there's two rows. There's X rows are when something is trending upward, and O's are a column when things are trending a little bit downward. And over time, everything else is similar, looking at higher highs or higher lows or trend or things like that. And point and figure charts have a few things that are quite useful for them. The first of which is that, as Alfred mentioned, there's minor trends. There's day-to-day swings in the market and a lot of chatter. And point and figure charts are designed to distill some of that out to really focus on the more significant price moves for signals. They also are really useful for helping when we do comparison charts across markets, and also that they have clear signals of when something has changed direction, when a pattern has been completed.
Perfect, thanks, Colin. And let's go on to another approach, relative strength analysis, not to be confused with RSI or relative strength index. Can you walk us through what relative strength analysis is and how it differs from RSI?
Absolutely. So I'll talk a little bit about the difference between the two, and then we'll show it. RSI is an indicator that was developed that helps a stock essentially compare its price moves with itself, and I'll speak to that on the next slide. Relative strength is designed to show the comparison and the relationship between two different assets. It could be stocks, it could be currencies, it could be sectors, it could be combinations of those. So and what it's showing is the relative price movement of one relative to the other, showing which is outperforming at a given time, which is underperforming. As I mentioned, a lot of the market comes from price, and the price moves tell us where capital is going. When investors are interested in something and bullish on something, they step in and bid the price up. When they're bearish and they're tending to sell, the price tends to go down. So if we can see where the price is moving up faster or moving up more slowly, it gives us a good idea of relative strength and really where the money is going, where the capital is moving, and where investors are most interested. So some examples here include the US dollar versus the Canadian dollar. That's a very common one. That's one we see reported on the daily news every single day. Or we can look at two sectors, the technology sector versus the auto sector, or as an example as well. So I'll show a few more examples of this, or Apple versus Walmart. One example from the first half of this year was the technology sector versus the energy sector. Energy stocks had done spectacularly well in the first part of this year, and technology stocks had done absolutely terribly. And this may be reversing itself a little bit in the last couple of weeks, but these are the kind of trends that we look at SIA and that investors look at that are really important for portfolio construction and investing. Next
Perfect.
slide.
And what are we showing on this chart here, Colin?
So this chart here gives us an example of the RSI indicator, which is, as I say, is a little bit different than relative strength. What the RSI measures is the relative strength of a stock against itself over a number of periods, and the default is usually either 10 days or 14 days for the RSI. And what it measures is how much prices go up on up days versus how much prices go down on down days, such that if something is really moving up quickly, then it's moving up more on up days and the price is climbing over that period, and the RSI tends to go up with it. So, and what this is used for in general is trying to find extremes, trying to find turning points, trying to find when maybe a stock has moved up a little bit too quickly and is due for a correction. So if we look at the RSI, in particular at the bottom, this is a chart of the S&P TSX Composite Index. And you'll see two lines, one going across at about 70 and one going across at about 30. And again, these are the defaults, but generally speaking, when the RSI goes above 70, it's considered, whatever the asset is, it's considered to be getting overbought. And then if it rolls back under 70, then it tends to be going into a correction. Likewise, if it goes below 30, it's considered to be oversold in the short term, that perhaps it's gone down a little bit too fast relative and not had these upward corrections, and that perhaps it's due for a more significant upward correction, which is often signaled when it climbs back above 30.
Perfect. Thanks, Colin. Now let's get back to relative strength analysis. I know you have some examples to show us here. So how can we use relative strength to analyze different markets here as an example?
Absolutely. So we have four charts here on this slide and the next one that compare the BMO S&P TSX Composite Index ETF ZCN on Toronto against different markets. So this first one here on the top of this slide is against the BMO ETF for the US market. And what this shows is this is a 3-year chart, and what it's showing is through 2019, 2020, and even most of 2021, the Canadian market was underperforming relative to the US market. It was trending downward. The US was outperforming. And then, however, at the turn of this year, at the start of this year, this trend changed dramatically. And we've seen the Canadian market outperforming relative to the US market up until, again, about a week ago. And that's because we started to see a correction in energy. So as I mentioned, the energy was outperforming technology. Well, the Canadian market tends to be more sensitive and more highly weighted in resource and in mining and energy stocks, whereas the US tends to be more heavily weighted in technology and communications. And the first half of this year, the two stocks more heavily weighted in Canada soared, while the two sectors more heavily weighted in the US dramatically underperformed. So we saw a real shift in the relationship and the relative strength between the US and Canada, between what had happened over the previous 2.5 years to the first half of this year. Moving down to the next one, we also see, oh, sorry, could you go back, Erin?
Sorry.
My apologies. The chart on the bottom here is the TSX, BMO TSX ETF against the BMO ETFs. ETF. So this is the international stocks, and we can see that in Canada that we did get a pickup earlier, and particularly at the beginning of this year, but it was a little bit less pronounced, a change in relative strength than what we saw relative to the United States. And that's because in a lot of cases, the international indices tend to be a little bit more balanced in terms of sectors than perhaps the US, not quite the big exposure to the technology and communications that underperformed, particularly in Europe. In the Far East, there is more of a sensitivity to technology. But of course, another index that's notable that's in overseas is the FTSE in the UK is more heavily weighted to energy and mining stocks relative to the US, similar to Canada and similar to Australia as well.
Great, thanks, Colin. And now some sector charts. Can you walk us through what this is showing us in terms of sectors?
Absolutely. So this first one here is comparing the TSX Composite Index relative to the BMO Oil and Gas ETF, ZEO.TO, and what this is showing us here is that in 1999 and the early part of 2000, the overall index was outperforming the energy sector, and in particular during that time, it was what I call the other part of the exchange. If you think of Canada as dominated by financials, materials, energy, and then everything else, the everything else group, which includes technology and industrials and utilities, had outperformed in 1999, particularly in 2020. But that has changed over since really about the fall of 2020. We increasingly have seen that the TSX overall index increasingly underperforming relative to the oil and gas sector. That shows us that how much the oil and gas sector has been outperforming over the last year and a half or so. And this last chart here on the bottom is the BMO bond ETF, and in this particular case, we can see that the TSX, interestingly enough, has been outperforming bonds really since the market bottom in 2020. It was particularly in the United States, it became much more clear since the start of this year, when bonds really started to underperform as a 4-decade-long downtrend in inflation and interest rates ended, and those both started to move up, and bonds really crumbled in the first half of this year. But interestingly enough, in Canada, equities, likely because we've had such a strong boost from energy and even materials up off the market bottom, that in fact the market itself had been outperforming bonds really for over 2 years now.
That's really good. Thanks, Colin. And then so intra-market analysis sort of brings it all together, and I know that you look at this in your process as well, examining the relationships between these 4 asset classes. Can you walk us through how this is done?
Absolutely. So we use as I noted on the last couple of slides, with relative strength at SIA, we do millions of calculations every single night of relative strength comparisons. And as we go through that, we look to see which areas are winning, which asset classes, which sectors are doing better than others, what is showing higher relative strength, and that gives us an idea of how where money is going and where capital is flowing, and different asset classes move at different times in the cycle. For example, early in the cycle, and we saw this in 2020 when interest rates were coming down, bonds which move opposite to interest rates really took off in 2020. And then a little while after the bonds started to move, the stimulus started to help to boost the stock market as well. Now, as interest rates have started to go back up, we've seen that bond prices started to come down, and then again stock prices started to come down afterwards, and then commodities themselves are a bit of a lagging indicator. They tend to be start moving up a little bit later, but then they tend to peak a little bit later, as we've seen with this year as an example. Bonds started to sell off quite early in the year. The stock market started to come down a little bit after that generally, and then it's only been in the last few weeks that we've seen that commodities and energy stocks really start to struggle. But then there's relationships with that. So for example, in Canada, when we're looking specifically at investing, commodities are really important because, as I mentioned, the 2 of the biggest groups in the TSX are energy and materials. So the TSX tends to follow be a little bit more sensitive to the commodity cycle than perhaps the general equity cycle that we see in the United States.
That's great, thank you. And then bringing it back to SIA, I know you touched a bit on how you guys do it, but walk us through your strategy when it comes to ranking and how you manage the tactical portfolios for us at BMO.
Absolutely. So when we're looking at different asset classes and where we wish to be at a different point in time, we look at equities, we look at bonds, we look at cash and currency as well, and commodities, and we break these down into smaller groups. And they're, as I mentioned, based on the comparisons of relative strength and and also the price movement, we see different things are ranked at different times, and then we focus investing on the highest areas. And this starts with a beginning of, do we want to be in equities? Do we wish to be in cash? And something we've seen over the last year was that equity markets, even though the large cap indices were moving up, a lot of the underlying indicators in small cap indices actually started to turn down about a year ago in the middle of 2021. And that because of that, we had seen the relative strength of cash starting to increase relative to other things. And as such, within the portfolios, the cash component has been steadily building over the last year or so. And then even within that, with the remaining equity components, we remained in the sectors that were showing the strongest relative strengths. So that had tended to, particularly in the last number of months, tended to favor resource stocks and defensive sectors such as utilities and consumer staples, whereas the weaker areas tended to be avoided, such as technology and communications, as again, particularly since the beginning of this year.
Great, thank you. Now, if you did want access to an ETF that provides you with technical analysis, these are two options for you at BMO, ZFC and ZFN, both managed by SIA. So the SIA focused Canadian equity fund and the SIA focused North American fund. And they're really tactical equity solutions. They're designed to give you access to SIA's relative strength analysis expertise. They're high conviction portfolios, so each holds about 15 equities, and they're unconstrained, and that means that they can be truly tactical. So as Colin mentioned, building up the cash portion, they can go to 100% cash at any given time if that's where their indicators tell them they should be. So these are two great solutions that we launched about 4 years ago now. How you can use them in a portfolio, you know, we still want you to keep that core portfolio, but where we see these fitting is sort of as a tactical sleeve in your portfolio. Colin, did you have anything else to add on this front?
Yes, and this evolves over time. So we've seen over the last 4 years where we have moved back and forth at different speeds between being 100% in equities or partially in equities or 100% in cash, and then back. And it's important piece of risk management, not only risk management, but also for being opportunistic. When I've spoken about how the indicators over the last year had deteriorated, and as that happened and risks increased, the portfolio shifted away from full-on equities towards increasing amounts of cash. But with the cash, then, when equity market conditions improve, and we expect that they will eventually, because they always do, at that point in time, then the portfolio is ready to move back into equities and to focus again on the areas of highest relative strength when that occurs. So it's a nice complement to a core portfolio, is this area that gives some focus on trading, on moving in and out, and on focusing on the highest relative strength areas.
Absolutely. Now, I want to wrap up here and turn to our audience questions. So thanks again for continuing to submit these week after week. It gives us a great idea into what you're thinking as our audience. So first one here, what is the BMO ETF that holds global oil and gas securities? So I think you're referring to ZEO, the BMO Equal Weight Oil and Gas ETF. We discussed this a couple weeks back on our commodity session. This is a Canadian portfolio of oil and gas companies, so just wanted to highlight that. The next question here, I'm going to give to Alfred. How will rising interest rates and inflation affect my portfolio in the long term? Will there be a slower bounce back?
Yeah, so generally higher interest rates means a slower economic growth environment. So you could assume that the equity markets are going to discount slower growth. So a lot of people are watching inflation and how central banks are going to react off of that, just in terms of monetary policy tightening and what they're going to do with interest rates. But overall, it will have an impact in terms of your portfolio, in terms of making it a slower growth environment. But keep in mind, there's other parts of the equity market that may outperform relative to the broader markets, things like dividends, things like value that may outperform. So there are ETFs that allow you to get those different factors in your portfolio.
Sure. Okay, and the next one is, what is the ETF fee for the BMO Equal Weight Bank ETF, and what is the ticker? So that's ZEB, and the fee's 28 basis points. Alfred, I'm going to throw this one to you. What is the outlook for technology stocks within ZIN? How has the performance of ZIN compared with ARC when overlaid?
Yeah, so it's been a very challenging year for technology stocks, but obviously a lot more challenging for the smaller cap technology stocks and the more innovative stocks found in ZIN and ARC. So, so far year to date, I think ARC is down 51% in terms of Canadian dollar terms. ZIN is down about 27%. So ZIN's fared a lot better. One thing to keep in mind is that because ZIN is, the way I think about it, it's more of a passive approach, whereas ARC is kind of more of an active approach managed by Kathy Wood and her team. ARC is going to ebb and flow more so than ZIN, just because the dollar flows that go into that ETF are going to push those stocks up. But overall, just in terms of outlook, if we've seen inflation kind of peak at this point and central banks are going to become less hawkish, that should be good for technology stocks, especially for a lot of the smaller cap innovative stocks held in both in ZIN and ARC.
Yeah, that more diversified portfolio in ZIN has definitely helped cushion the downside a bit. Okay, so that caps off another great week of ETF Market Insights. Thank you very much for tuning in. Next Friday, we're going to be discussing the hot topic of inflation. I think this is on everyone's mind. It seems to be climbing higher and higher each month. We'll hear from our experts. We have Jennifer Lee joining us from BMO Capital Markets. She's a senior economist there, and Alfred Lee will be back. I'm off on vacation, so Kevin Prince will be hosting next week, but we hope you can join us then. Bye for now.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.